Ever wonder why you can be pre-approved for a personal loan but still have to wait for final approval? You're not alone. Many borrowers find the personal loan application process confusing, especially when it comes to loan pre-approval versus approval. In this video, we'll walk through the entire process and explain the difference between loan pre-approval and final approval in clear, simple terms. Think of it as having personal loan approval explained step by step. By the end, you'll know exactly what each stage means, how they differ, and what you can do to improve your chances of success at each step. We'll start with a quick overview of the personal loan application process, then dive into what pre-approval really means, what happens during final approval, and how to go from that initial "you're pre-approved" message to actually getting the funds. We'll also share examples and tips along the way to keep you informed and engaged. Let's get started. To put things in context, let's briefly outline a typical personal loan application process. Understanding the big picture will help clarify where pre-approval and final approval fit in. Initial inquiry, pre-qualification, pre-approval. You provide some basic information, like your income and credit details, and the lender does a quick check. If you meet the criteria, you receive a pre-approval or pre-qualification, indicating you're likely to qualify for the loan. This is essentially a preliminary green light, based on estimates of your financial situation. Full application submission. If you decide to proceed, you fill out a detailed loan application and submit any required documents, proof of income, ID, etc. Underwriting and verification. The lender's team reviews your application in depth. They verify the information you provided, checking your documents, credit report, and other details. This is the crucial review stage that happens before final approval. Final approval, or decision. After underwriting, the lender makes a final decision. Final approval means your loan is officially approved, pending you agreeing to the terms. If something doesn't check out, the loan could be denied, or the lender might ask for more information. Loan agreement and disbursement. Upon final approval, you'll sign the loan agreement. The lender then disperses the funds to you, often by direct deposit. Now you can use the loan and will begin repayment as scheduled. Throughout this video, we'll focus on the two stages that often cause the most confusion: pre-approval versus final approval. Let's break down each of these and see what sets them apart. Personal loan pre-approval is essentially a preliminary indication from a lender that you may be eligible for a loan based on an initial assessment of your financial information. Think of it as the lender saying, "At first glance, you look like a good candidate." At this stage, the lender has likely considered factors like your credit score, income level, and maybe past repayment history. The key point: this is not a guarantee of a loan, just a tentative offer. Pre-approval often requires minimal effort on your part. You might fill out a short online form or receive a pre-approved offer via mail or email if you're an existing customer. In return, the lender gives you an estimated loan amount, interest rate, or a range of terms that you could qualify for. For example, you might see something like pre-approved for up to $10,000 at X% interest. This gives you a ballpark idea of what you can borrow and on what terms. One important feature of most pre-approvals is that they use a soft credit inquiry, basically a peek at your credit that does not impact your credit score. Lenders do this to judge your creditworthiness without dinging your score. Since it's a soft check, you can safely get pre-approved by multiple lenders to compare rates, and it won't hurt your credit. In contrast, a full application triggers a hard credit inquiry, which can temporarily shave a few points off your score. It's worth noting that some lenders use terms like pre-qualification interchangeably with pre-approval. In general, both terms mean an initial check to see if you might qualify. Pre-approval is sometimes viewed as a slightly more formal or definitive step than pre-qualification, but the idea is the same: a conditional yes, not a final yes. The lender is essentially saying, based on what we know so far, we're likely to lend to you. Crucially, pre-approval is not the same as final approval. It merely suggests you are a strong candidate pending further verification. You haven't gotten the loan yet. Unfortunately, some people see pre-approved and think the money is guaranteed, only to be surprised later. Pre-approval is conditional. It's like being invited to apply with a high chance of success, but it's not a binding commitment from the lender. In the next section, we'll see what it takes to move from this conditional stage to the real deal. Final approval is the official yes from the lender, indicating that your loan application has been thoroughly reviewed and fully approved. This is the point where the lender commits to giving you the loan, and all conditions have been satisfied. You can think of final approval as crossing the finish line of the loan application process. To reach final approval, a lot happens behind the scenes. Once you move past the pre-approval stage, you'll submit a full application with supporting documents. The lender, often through an underwriter, will verify all your information from the pre-approval stage. This typically includes checking your income documents, pay stubs, W-2s, bank statements to confirm you earn what you stated, and employment status, verifying your identity and address, and performing a comprehensive review of your credit report. In other words, they look for proof that what you told them initially is accurate and that no new issues have arisen. As part of this verification, the lender will conduct a hard credit check if they haven't done one already. Unlike the soft check at pre-approval, a hard inquiry gives the lender a detailed look at your credit history and can slightly lower your credit score in the short term. Don't be alarmed. This impact is usually small and temporary, and it's a normal part of getting any loan. The lender will review your outstanding debts, credit utilization, and payment history in this step. During underwriting, the lender is basically asking, do you still meet our criteria now that we have all the facts? They might also ensure nothing big has changed since pre-approval, for example, that you haven't suddenly taken on a lot of new debt. If everything checks out and the lender is satisfied, they will issue a final approval. Often you'll receive a formal notification or a commitment letter saying your loan is approved, along with the exact terms, loan amount, interest rate, term length, monthly payment, etc. At this stage, the approval is unconditional, meaning the lender is ready to fund the loan. You'll then be asked to sign the loan agreement to accept the offer. Once signed, the lender will disperse the funds to you, which could be as quick as the same day or a few days later, depending on the lender. It usually takes a bit of time to go from pre-approval to final approval. Pre-approvals can be instant, whereas final approval might take a few days up to a week after you submit your documents. For example, many online lenders can finalize a personal loan within a couple of business days, while some banks or credit unions might take a little longer, closer to a week, to review everything. The wait isn't usually too long for personal loans, but it's definitely longer than the near-instant pre-approval. Final approval is the moment you can truly breathe a sigh of relief. Your loan is officially happening. But remember, if something in your documentation or credit review doesn't match what was assumed in pre-approval, the lender can change or withdraw the offer. Final approval only comes after all conditions are satisfied and the lender is confident in your ability to repay. In the next section, we'll directly compare pre-approval and final approval to cement our understanding of the differences. It's clear that pre-approval and final approval are very different stages in the loan process. Here's a side-by-side comparison of the key differences. Depth of review. Pre-approval is based on limited information, often just self-reported data and a cursory check of your creditworthiness. The lender gives an estimate of what you qualify for without verifying documents yet. Final approval, on the other hand, is based on a full verification of your financial information. The lender has reviewed pay stubs, bank statements, credit reports, etc. in detail before giving the official nod. Conditional versus official. Pre-approval is conditional. It's essentially a good chance letter, not a guarantee. The lender is saying you'll likely be approved if everything checks out. Final approval is official. It means the lender has formally agreed to lend you the money. At this point, the offer is binding and solid. assuming you sign the agreement and don't violate any last-minute conditions. Credit inquiry type. With pre-approval, the lender usually uses a soft credit inquiry, which does not impact your credit score. It's a preliminary check. For final approval, a hard credit inquiry is performed as part of the underwriting. A hard inquiry gives a thorough view of your credit and can slightly reduce your credit score for a short time. Essentially, pre-approval is a no-risk peek at your credit, whereas final approval involves the full credit check. Speed and effort. Pre-approvals are fast and easy. You might get a decision in minutes or seconds online. No documents are required at that stage, and it might even come unsolicited, like a pre-approved mail offer. Final approval takes longer and requires effort from you. You have to gather paperwork, fill out forms, and then wait for the lender to verify everything. This can take a few days to a week for personal loans. In short, pre-approval is a quick initial screening, while final approval is a thorough final review that takes more time. What you receive. Pre-approval provides an estimate. For example, you're pre-approved for a loan up to $5,000 at around 8% APR. These terms are tentative and could change if, say, your verified income doesn't support that amount. Final approval gives you the exact offer. You are approved for a $5,000 loan at 8.5% APR, 3-year term, with a $XYZ monthly payment. At final approval, you know exactly what you're getting, and you can proceed to accept the loan. Outcome. If requirements not met. With pre-approval, because it's conditional, there are cases where a borrower might be pre-approved, but then denied at final approval. Why? Because the final checks revealed something that the initial check did not. Common examples. The borrower's documents don't match their application. Perhaps they stated a higher income than they can prove, or their financial situation changed, like taking on new debt or a drop in credit score, between pre-approval and final approval. In contrast, if you've reached final approval, the expectation is that the loan will be funded. It's rare to lose a loan after final approval unless you fail to sign the paperwork or some extraordinary issue arises. In mortgage lending, there can be last-minute conditions, but in personal loans, final approval is usually the last step before funding. In summary, pre-approval is an early thumbs up with a few strings attached, whereas final approval is the clear-to-go, all checks complete confirmation. Pre-approval gets you in the door. Final approval lets you walk out with the money. Imagine Sarah, who wants to take out a personal loan to renovate her kitchen. She visits an online lending platform and fills out a short form with some basic details: her income, estimated credit score range, and the loan amount she's looking for. Within seconds, Sarah gets a message saying she's pre-approved for a $10,000 personal loan at a 7% interest rate. This pre-approval is exciting for her. It indicates that based on the info she provided, the lender believes she is a good candidate for the loan. So far, Sarah hasn't provided any documents. The pre-approval was based on her self-reported income and a soft pull of her credit. She hasn't committed to anything yet, but she has a quote that tells her, "If all checks out, we can likely lend you up to $10,000 at 7%. Now, Sarah decides to move forward and get that loan. She clicks Continue on the lender's website to proceed with the full application. The lender now asks her for proof of the details she gave. Sarah uploads her recent pay stubs and last year's W-2 to verify her income, provides her employer's contact info or an employment verification letter, submits a copy of her driver's license and a utility bill to verify her identity and address, and authorizes the lender to do a full credit check. This is the underwriting phase where the lender digs into the details. A day or two later, Sarah hears back from the lender. Good news. She receives final approval for a $10,000 loan at 7% interest, 3-year term. The lender confirmed that her income was indeed as stated, her credit report looked solid, and all documents were in order. They send over a loan agreement for her to sign electronically. She signs it, and the lender deposits the $10,000 into her bank account the next business day. Sarah's loan is now finalized and she can start her kitchen renovation, making sure to budget for the monthly loan payments in her finances. Now, let's consider an alternate scenario to highlight why pre-approval isn't a sure thing. What if something didn't check out during verification? For example, suppose Sarah accidentally overstated her income on the initial form, saying she made $75,000 a year, when in reality it's $60,000. Perhaps she included bonuses that weren't guaranteed. When the lender reviews her pay stubs and tax returns, they discover this discrepancy. This kind of mismatch can cause a denial after pre-approval. The lender might decide she can't actually afford the $10,000 loan with the lower income. A pre-approval isn't binding for exactly this reason. It's contingent on everything checking out. In this scenario, the lender could either reject the application or perhaps offer a smaller loan amount due to the lower verified income. There are other reasons someone could be pre-approved and then get denied or modified at final approval. Let's say between the pre-approval and final review, Sarah's credit score dropped significantly. Maybe she ran up a credit card or missed a payment. A drop in credit score or any major change in credit health could make the lender reconsider. Or imagine Sarah switched jobs in the middle of the application. A change in employment might raise a red flag and delay or derail the final approval. Lenders also check for things like undisclosed debts. Maybe Sarah took out a car loan that wasn't initially evident. Any such changes are common reasons a pre-approved loan might fall through during final processing. The takeaway from these examples is, pre-approval is a promising start, but final approval is where it counts. As a borrower, you want to keep everything consistent between those stages. In Sarah's successful scenario, she kept her financial situation stable and was truthful on her application, so final approval was smooth. In the what-if scenario, inconsistent information led to a problem. The takeaway from these examples is, pre-approval is a promising start, but final approval is where it counts. As a borrower, you want to keep everything consistent between those stages. In Sarah's successful scenario, she kept her financial situation stable and was truthful on her application, so final approval was smooth. In the what-if scenario, inconsistent information led to a problem. Maintain a strong credit score. Keep up the healthy credit behaviors that got you pre-approved in the first place. Avoid any late payments and don't max out your credit cards. Ideally, continue to pay down existing debt if you can. Lenders typically consider a score above 750 as excellent, but wherever you are, the key is not to let it drop during the process. Essentially, don't do anything that could lower your credit score between pre-approval and final approval. Avoid taking on new debt or credit. This is not the time to open a new credit card or finance a new car. New loans or credit inquiries could alter your financial picture and worry the lender. Press pause on any new borrowing until after your personal loan is finalized. Keep your debt-to-income ratio stable. Keep your documents ready and accurate. Gather the documents you'll need for verification: pay stubs, bank statements, tax returns, ID, proof of address, etc., and ensure they are up to date and consistent with what you stated on your application. For example, if you said you earn $5,000 a month, make sure your pay stubs actually show that. Any discrepancies should be resolved before you submit. Honesty and accuracy on the application are crucial. Don't change jobs or make major financial moves if possible. Lenders prefer stability. Quitting your job or switching employers in the middle of a loan application can complicate things. It's not that you'll be automatically denied, but it adds uncertainty. If you can, try to maintain stable employment until your loan is approved and funded. Similarly, don't suddenly co-sign another loan or make a huge purchase that drains your savings during this period. Respond promptly to lender requests. If the lender asks for additional documents or clarification, reply as quickly as you can. Prompt responses keep the process moving and show the lender that you're cooperative and prepared. Dragging your feet could delay your approval or even cause the offer to expire in some cases. Double-check your application for accuracy. Before you hit submit on that full application, review everything. A small typo in your social security number or a misreported address could cause a verification hiccup. Make sure your application info matches your documents exactly. Consistency is key to avoiding unnecessary questions during underwriting. Stay reachable and keep an eye on your email phone. The lender might contact you with questions or updates. Missing a phone call or email for several days could slow down the process. So, after you apply, be a little extra attentive to your communications. Following these tips can significantly increase your chances of a smooth journey from pre-approval to final approval. In short, keep your financial picture stable, be honest and accurate, and promptly fulfill any requirements the lender asks for. If you do that, you've done everything within your control to get that loan across the finish line. In conclusion, pre-approval and final approval are two very different milestones in the personal loan process. Pre-approval is like an initial vote of confidence. It means you look eligible based on a quick look, but it's not a guarantee of funding. Final approval is the official confirmation after thorough verification that says you're approved and the money is on its way. Understanding the difference between these stages can help you manage your expectations and responsibilities when applying for loans. By now, you should have the personal loan application process and the role of pre-approval versus final approval clearly in mind. Remember, loan pre-approval versus final approval comes down to conditional offer versus definite offer. Getting pre-approved is a great first step, but it's not the finish line. The loan isn't yours until it's final approved and you've signed the dotted line. Keep that in mind, stay honest on your application, and maintain your financial stability through the process. We hope this guide has effectively explained personal loan approval in a way that's easy to grasp. Armed with this knowledge, you can confidently navigate your next personal loan application, knowing what to expect at each stage. If you found this information helpful, feel free to like this video and share it with others who might benefit. Thank you for watching, and good luck with your personal loan journey. Stay financially savvy, and we'll see you in the next video.